Ladies and gentlemen, welcome to the study. Going to be talking about earnings per share, EPS, and why this is so important and a popular metric that's used everywhere in the stock market. So before we proceed any further, I would like to state that the information in this video is not a recommendation to buy or sell any securities and is for educational purposes only. Earnings per share, or EPS, is the company's profit divided by the number of outstanding shares of stock. This number is going to tell you the company's profitability, and what we're going to do is we're going to take a look at the formula. It's very simple. You take the money, the income that the company is making, right? And you are going to remove the preferred dividends. So the dividends, remember, they're a share of the company's profits to the shareholders. So while they pay that dividend out, you want to make sure you eliminate that from the total, and then you take in their net income. So the net income minus the dividend payout, and then you're going to divide the total number of shares outstanding. This will give you the earnings per share. We can do a quick example with the formula just so you get familiar with it. Let's take a company that makes $8.5 billion net income, right? They pay 0 dividends and they have 4 billion shares outstanding. We're using easy numbers here just to get the idea of how to calculate this number. So you take 8.5, you would divide that by 4, and you would get 2.13 EPS, or 2.12.5, but I'm rounding it up to 2.13. So what does this mean? If a company has a high EPS, right, they are more profitable. As the lower the EPS is, then they are going to be considered less profitable. And EPS is one of the most important metrics to consider when looking at individual companies to invest in. How is that EPS number used to determine the importance of these companies? Well, it can be plugged into a commonly used financial ratio known as the PE ratio that I have here. The PE ratio, or price to earnings ratio, the way how this works is that we take the price of the stock divided by the EPS. So let's review the EPS. The EPS, remember, we're taking the income, right? We divide that income by the number of shares outstanding. And before we do that, we have to make sure that if the company does pay out any dividends, make sure to subtract that from the net income, and you'll be good to go. That will get your EPS number. You would plug that into the bottom here, stock price divided by the EPS, and you would get your PE ratio. So what does this mean, or how is an easier way to understand this? Because it can be a lot of information, and my goal with this video is to make this a quick summary, simplified approach on how to see the PE ratio works. And I'm going to save you a lot of time right now. This is how much the market is willing to pay for each dollar of earnings. Think of PE ratio that way. So in other words, this is your cost to buy a dollar of profit. If a stock has a PE ratio of 20, then the price is 20 times more than the dollar amount it generates through its earnings. So this would suggest a very high valuation, right? Let's say a PE ratio of 10 for this example. 20 to 10 is considered a very big difference. That is double the amount. So when you have a PE ratio that's lower, it would suggest that that one with 10 is going to have a low valuation. Therefore, you could see that as a value investment or a discount at the current stock price compared to the company that's trading at 20 times PE. So you might be getting the idea now. If the PE ratio is 10, it costs you 10 to buy a dollar of profit. If the PE ratio is 20, it costs you 20 to buy a dollar of profit. Now, let's use the EPS that we calculated before, right? We had 2.13 it was, and let's say the stock is trading at a share price of 240. All right, so 240. Whoops, let's clear that. Okay, 240 divided by the EPS, 2.13. That was our EPS that we had got before. It's going to come out to a P ratio of 112 with 67 cents. So you are purchasing these shares. If you want to make a purchase on these shares in this company, you're looking at a P ratio of about 112.67 times earnings. So going back to what I said, how much is the market willing to pay for each dollar of earnings? That is the ultimate way of looking at the P ratio. In other words, to buy a dollar of profit, that is your cost, $112 with 67 cents to get a dollar of profit. So very common to see these big numbers with these high energy growth names, that the stock price moves in wide ranges and fluctuations, and they're just volatile to say the least. So I don't want to spend too much time on PEs, but when you take companies within the same sector and you look at their relative PE ratios, you may be able to get a better idea of valuations within the sector. And this is one of the very useful tools you can use from knowing the EPS. So the EPS can also be used as a way to see the company's trend on their earnings versus company competitors. And this really helps give you an idea where the company is going moving forward when comparing to their competitors and looking at the potential that these growth stocks and other stock names that could actually end up being growing at a faster rate. Like that's remember, when we're looking at growth stocks, you want to make sure you target individual companies that grow at a faster rate than the market average. And a great way of doing this is I like to pull out an Excel spreadsheet and plug in the values myself. There are other tools online. There are so many websites, platforms, services. I like to do it myself, and I like to encourage others to run through the data themselves because it really helps give you an understanding and a solid foundation of measuring this type of data that we see when companies report their earnings. So in this example, I took about, looks like I got 10 quarters. Yeah, that's what I did. I did 10 quarters. And so I got company A and company B. I took their earnings and I compared them side by side to kind of see the trend. And what I learned from here is one thing is that the EPS is moving quite significantly in both these companies. So there's definitely some activity going on here. You could see that the orange, the group B or company B, has wider moves in their EPS. And especially when we look at this point right here, you could see that they reported about a loss of 7 cents. Then it went to about a point of 13 cents, and then all the way above 40 cents, which indicated a significant jump and potential growth company that you may want to invest in when you see these big runs. But remember, these big runs can also have big drops, which you saw here. And it's very interesting when you compare. The other company is also making great strides, but not as wide as the other company, company B. Company A is a little bit more steady and not as volatile, because at the end of the day, when we go from point A to point B, right, this line chart, both companies actually ended up increasing their EPS quite significantly over the course of the last 10 quarters. And these are the things that you want to make sure that you're eyeing on these companies, it's not always going to be as easy to kind of see the clear picture. And this is a very good example because it's challenging where, hey, this company looks like they're doing great, but they had that big significant pullback. Same thing with Company A. Company A went from a loss of 10 cents and almost to about 10 cents positive on their EPS, and then they pulled back to zero and then started building up their momentum again. Pretty much the same story with Company B. So there's a lot of information you can get from doing this exercise, practicing it yourself. Definitely recommend it. And another thing that you can see why the EPS is so important, and what I wanted to talk about next is earnings season, right? You can pull it up here. I have an example with a company called Affirm Holdings. And EPS is used during earnings season when all the companies listed on the market are set to report their earnings, profits, daily active users, a whole bunch of other metrics to shareholders. Many times traders and investors place bets depending on the EPS, and you can actually see different analyst estimates, the pricing on what the street is betting, then the number the company reports of the EPS compared to the Wall Street estimate on their EPS, which can either result in three outcomes. And are you guys ready for the three outcomes here? One, it could meet expectations, which usually generates a flat response. Two, the company could end up missing expectations and reporting below the estimate, which usually generates a negative response. This can be really dramatic because look at this one, for example. You have Affirm on the chart here, which eventually reached a high of $176.60. And then it got crushed on really bad earnings, fell all the way down to about $133, $132. So, yeah, it's just like really crushing. And just, it can get people pretty sad and emotional. And again, that's why I always say, hey, you got to keep your feelings out of the stock market. Again, the fast forward here. Pretty bad earnings once again. Stock was at 73, now at 58. Like what, a 20% drop? Again, another sad earnings result. That's just people don't want to be in this name anymore if they are not executing on making income and on their earnings. If the company lastly beats expectations, reporting above the estimate, which then generates a positive response in the company stock price usually, that's really good news. That will get everybody just excited, ecstatic, and they want to be more involved, put more of their money into this company. So it creates this just this opposite feeling that you're seeing on this chart with Affirm, where the last two earnings, they didn't do so hot. There's also other factors to consider when going into earnings, but this is the main grasp of it, and it's not always just that simple. Of course, there are other factors as well, so just a heads up on that point. So, at the end of the day, the advantages to EPS are that it can be used as a measure to price stocks. In other words, a higher EPS attracts higher prices. A lower EPS attracts lower prices. It tells you the profit per share after paying off all of the liabilities, such as interest on debt that the company may have took out, and the dividends that they pay out to the shareholders. Remember, when you are getting that number, you have to take out the dividends, and then you take the net income divided by the number of shares outstanding. That goes back to the formula that we covered in the very beginning of the video. So what about the disadvantages or limitations? And this is actually pretty important to consider. You can decrease the number of outstanding shares. So if a company does this, remember that number is the denominator in the formula. And if you look at that formula, let's go and pull it up right here. I have number of shares outstanding. As this number gets smaller, the top number is going to get bigger for that EPS. It can be quite deceiving if the company decides to manipulate that EPS number. A common example of how this can occur is through a reverse split of stocks. So if the company says for every 10 shares you own of company XYZ, right, you will now have one new share. That would be a 10-to-1 split. So kind of a backwards of a company issuing more shares. What the company does is that they remove those shares available. And actually another popular way how this can be done is when a company does a buyback of the shares. Because remember, when they do a buyback of the shares, then that lowers the number of shares available outstanding in the market. So if you're familiar with looking at different stock prices when comparing companies to each other, having this EPS as a tool is going to help you further compare these companies. This will help you see the bigger picture overall when picking different investments. This is all I have for you guys today. And I wanted to accomplish my goal of making a quick video. I might have took a little bit longer on how to calculate this number, the EPS, what it means, some of the limitations, some of the benefits, and hopefully this information helps you guys out. I know it's a little bit of a weird concept to grasp at first, but the more time you spend looking into it and practicing it and getting used to seeing this number regularly as you navigate through the markets, it's going to make a lot more sense. And hopefully this information helps you guys out. If you do have any questions, please let me know in the comments or message me. And if you enjoyed this video, make sure to leave a like and subscribe for more content. You can visit me at thetradestudy.com, and I will see you in the next one.